So welcome to Dr. Carl Society Mission. This is the mini economics, accounting, and finance. So we look at the general equation, the economic equation: asset is equal to liability plus equity. So when you are going to set up a company, you have your own money, then you may borrow some money, you put them together, and then that will form the asset, the company. Okay, right. So this is the ALE, Ali. Right. So your money, we have the debit part, and then we have the credit part. Debit is the destination, credit is where it is coming from. Okay, so loan to your bank. So loan is coming from loan, that's credit. Destination is the debit, that is the asset, it's going to the bank of the asset, so it's D. And the same thing is coming from you to the company, and that is also coming from here, can also be here to the asset, and that is, it is from, and this is to, from, this is to, right? So this is the source, I prefer to use source, and this is the destination as D, so that you remember it's debit, but this is debit, okay, and this is credit, right? So debit, credit. Now, so that is it. So this is for what has been done. Now in the future too, we can have the able or receivable, we can have the payable. Okay, so payable under liability, something that you have to pay, you owe them, you have to pay later. And then those that are receivable in the future, also there, right? So this is what you have not yet done, but in accounting, double entry, and then also for accrual system, that is, we take into account what will happen in the future, especially when we have law to back it, or we think it is certain that it will happen. Okay, right? Or we have some degree of, so asset, you have some degree of control. Right? Ability, you are looking at how you can settle your debt in the future. Okay, right? So degree of control for assets. Okay, either ownership or degree of control. And this one is, we look at how we can settle our debt in the future. Right? So so we have what we have done already, what we are yet to do, both are captured in the accounting system. Then, so we come towards the second part. After we have established the company, we now want to go into business. So when we sell, what we get is the revenue, okay, right, or income, what we get. Now when we get that money, we push it into the we may use that money for expenses, or we'll send it into our bank account. Okay, right, that is what usually happens. So it goes into our bank account, so it is coming from revenue, so credit, and going to asset, which is the destination, so debit. Right, now what will happen is, when we send the money into the bank, if we want to buy something, make some expenses, buy some raw materials, okay, pay salaries, then the money will come from our bank account. So because it's coming from a bank account, we must first shift the money to credit, and then from credit it will come to expenses. Okay, so anytime you want to move money from and then to, the from must be credit. So if it is debit, you shift the money to the credit, and then from credit you move it to debit on that side. So here you see they are all on the same side, debit, but you have to move the money to the credit side before you can move it. So it's double entry, it's from credit to debit. Okay, so this is just the movement. We are not saying it's profit and loss, it's just the movement. So it's important you note, when it comes to profit and loss, okay, that one we look at the single account, not just the double. So we look at what we are getting as revenue, we subtract our expenses. Okay, right, then that will give us some levels of profit. We have different types. Okay, gross, okay, EBIT, and so on, but this is for adult class. Right, now let's look at what financial equations that we can, financial concept that we can also. So here the same thing that we said, we are setting up company. So this is loan that is coming to you, your own money that you are investing. Okay, money that you are investing. Okay, so the two together will become your asset. Now this asset you may use it for other things. Okay, so this is what goes into it. Okay, so you buy raw materials, you make your production. Okay, then you have cost and other things to do. Then ultimately you are now going to start selling. So when you start selling, let's say you start selling, you generate revenue. Okay, then this revenue is what is going to take care of your expenses, and then whatever is left as your profit, you retain some. Okay, and then you use that to pay the dividends. So this is dividends. Okay, that is those with shares, those who have ownership, ownership in your company. So when you add all the shares, we call that stock. Okay, right. So we can have data on these things. Okay, we can have data. So different. We can have different shares and stocks. Okay, together. Okay, so you can manage this in different firms. Then all together we'll call that portfolio. Okay, so you can have data to analyze your portfolio. Okay, the shares and other things. Okay, right. So it's important. Sometimes you don't keep your money in just one place, in different places, so that when something happens to one, the other one can balance or help you not lose all. So we have different ways of doing that. We have diversification, hedging. Okay, right. We'll talk. These are for adults. We'll talk about them later. Right. So, right. So that is that. Now let's see. This is the time frame. Listen. So now this is where we are. We can predict what will happen in the future by using time. So for prediction, we use time factor to get the amount. Now we can also forecast. When it comes to forecasting, we usually want past actual expense data that we have, past actual expenses of what that we have done, and then we look at what the prediction is also telling us. Okay, so we factor the two together to get our forecast. Okay, and there's an equation for that. We'll talk about that. This is just the basics. Okay, so that will give us the forecasted, but we usually will also not just use simple average. We will use what we call the weighted average. So the weighted average, we consider how much each is important to what we are doing, and then give them a certain uh, figure as their factor. Okay, so that is the difference for the weighted average. It's not the simple average where each individual will have the same factor, right? So that is it. Now we also will look at the markets. So those within 1 year T-bills, okay, we usually will pay the whole sum once. But if it's going beyond 1 year, we have the bonds, we have the credit markets. Okay, for them you pay in bits, and then when you are making your final payment, you add your principal to it. So we have a way of calculating this. 1 plus r is a factor for compounding. That's compound interest and all that. So we can use that to predict what we'll get in future, and also use that to predict what a future value is worth now. So you see, if we want to get in future, we have a certain value, future value, we want to get its present value, we use this equation: PV over FV over 1 plus R. R is the interest, or the frequencies. Okay, and then N will be the years that we're talking about. Right, so that is it. So this is a simple way to look at finance. We'll talk about it again. Now let's look at economics. In economics, we usually will talk about demand. So let's say if you have 10 oranges, you say I'll pay 10 cedis. But if you have 100 oranges, then I'll say no, I won't pay 10 cedis. I will rather pay 5 cedis for one. If you have 200, then I say no, because you have more, then I have to give you less. Okay, I'll give you less. Okay, so you see that when the number of when the price is high, you usually will buy a small one. When the price is low, you buy more. That is what happens for those of us who are who are asking for the goods. Okay, when it comes to the company, they are supplying. Okay, so this is more or less like customers. Okay, they are supplying. So for them, when the price is low, they will supply few. When the price is very high for one, so there is a price for one. When the price for one is very high, then they will want to get more money, so they will they will supply more. So if you put the two together, this is the equation. Where they meet is what we call equilibrium, okay? And that will be the price, okay? Right. So this is something small we can sketch to talk about, okay? Right. So this is a company. They produce the toffees. We are the people who consume the toffees, okay? When the price of the toffee is small, we'll buy more. But the company, when the price is small, they will produce less, okay? So when you put the two together, we will then know at a certain point how much these people, how much toffees they will give us, and then how much we are also willing to pay for that. And that is what we call the equilibrium. Equilibrium, okay? Equilibrium price, okay? And this is the equilibrium quantity. All right. Now let's look at the market. We talk about the market. So when the market is producing the same quantity, okay, then anybody can produce it. Everybody can produce it. There's no restriction. We call that the perfect market. It doesn't usually exist. Okay, so on the industry, that is when all the companies are put together. This is how the graph of demand and supply will look like. But for one firm, this is how it will look like. Because it is flat here because for you alone, your shares, the number of companies that, or the number of customers you are getting, they are few. So if you change price more, then they'll all move away to the other ones because they have other places that they can easily get the same product. So in that sense, this is flat because the least change in price, they are moving away, and that is why it is flat. Now this is for the monopolistic and then monopoly kind of. For them, they have control over quantity and price. Okay, so they will tend to produce less so that the price will be higher. So there's always some waste in the system. The waste in the system is what you call dead weight. Dead weight. Okay, so government has to sometimes come in to stop these monopolies. Okay, so that we can get to a perfect, a good way of a good production state, right? So the same thing as now when it comes to the whole country, our income will be linked to the consumption, how much we are consuming, we are investing, the government expenditure, and then what we are exporting and importing, the balance. Okay, so this is, we'll come to this one. So there's no need to talk when we get to the right age. We'll talk about that. So just something small introduction. So these are the things. Okay, so this is our goods market. Demand, we are demanding, they are supplying, and this is the money market. The Bank of Ghana is supplying money, we are also demanding with a certain level. So the price of the money is here. Now we can put the two markets together and get what we call the LM and then IS. So here we have money market and goods market together. Okay, so what we are demanding with our money, okay, and what is being money is that is being supplied because of what we are demanding is here. Right, so this will give us a good picture of the two markets together, both. Right, so this is the summary for those of us who develop interest in economics, accounting, and finance later. Thank you very much.